Hi, this is Jeff Camarda. This section is on immediate annuities. Now, immediate annuities are annuities in their purest form. With them, the buyer irrevocably, which means you can never change your mind and undo the contract, converts principal into income paid monthly, quarterly, or annually, which is some of the common intervals, or every blue moon for a specified term. This term can be for a period of years, and a good way to think of these annuities is like mortgages in reverse. Instead of borrowing a sum and paying it back with interest over so much time, you actually lend, a sum of money in exchange for payments with interest until the contract has been repaid. The payback term can be very straightforward, like for 20 years, and at the end the entire sum has been returned at the contracted rate of interest. This simple type of annuity, I know it sounds pretty complicated, but it really is the simplest of them, is called for a period certain annuity, and the insurance company makes money by paying you a rate of interest lower than it expects to be able to earn on the money that it invests. These days, that's pretty much zero. This is very similar to how a bank makes its money on the spread between what it earns and the lower amount it pays depositors. And if you look at what CDs have been paying lately, that's a pretty good analog for what the pure, true annuity interest rate is if you buy an annuity, though it's a lot harder to figure out. Buyers take note. In the ultra-low interest rate environment of the post-Great Recession world, the 20-teens and perhaps even the 2020s, in many cases, annuity payments may be calculated such that you barely get principal back with little to no interest, and it's possible, very possible, you get back much less than you put in. There are many, many moving parts, and this is an oversimplification, but it's entirely possible to contract to receive lifetime payments that add up to less than you put in, sort of a negative interest effect. You've got to read a lot of complicated contract language and policies, which almost nobody wants to and rarely is done. And if you just rely on the salesperson's sweet siren song and maybe the slick brochure, you may get a whole lot less than you thought you were. But annuities, being life insurance contracts, are subject to the dark art of actuarial science, the cold equations of money and death, and most annuities are based on payouts figured on the life expectancy of the annuitant. That would be you, typically, if you're buying the annuity. With enough lives in a pot, an actuary can pretty precisely calculate the average payout period based on the average life expectancy of annuitants, and price annuity interest payout rates accordingly, such that the insurance company is very likely to make money. A pure life annuity pays for only so long as the annuitant shall live. Annuity payments continue only so long as the annuitant is alive. If we assume an average life expectancy of 20 years for a given age class, the insurance company really makes out on those that die sooner and gets hurt on those that outlive the 20-year life expectancy. This latter point, the ability to contract for income lasting longer than life expectancy if you live a long time, really is a key benefit of annuities that nothing else except a pension, which is really an annuity if you look at it carefully, will do. So this is actually a feature, a very valuable feature that nothing but annuities will do. There will be more on these so-called longevity credits later in these videos and in the Wealth Matters material. But of course, as in Vegas, the insurance companies don't ever expect to actually get hurt. Sometimes they do because they miscalculate, but it's rare. So long as they have enough players and they get the odds right, the law of averages come into play, and the house will always win with those two provisos, since it's the one who gets to set the odds, again, provided it's smart enough to set them right, which isn't always the case. So let's look at an example. Let's look at an example from the good old days when the word interest actually meant something. Say we assume an average life expectancy of 20 years and a $100,000 annuity premium to be annuitized into income. Also say that prevailing investable interest rates, like on high-grade corporate bonds, mortgages, and long-term government bonds, average 8%. I know that sounds like a pipe dream these days, but it's been very true in the past. And the insurance company can invest annuity premiums at that rate. Investing $100,000 at 8% for 20 years will pay some $836 a month for 20 years, after which, just like with a mortgage in reverse, the principal would have been repaid with interest and the payments will cease. If the insurance company sets its annuity payout rate at 5%, the annuity will actually pay $660 a month, leaving a spread profit for the insurance company of 3%, or something like $176 a month. This will translate into a profit of $104,000 for the insurance company at the end of the 20 years, before expenses, of course. This is the same thing as saying that $176 invested each month, the extra earnings on the annuity premium that the insurance company gets to keep, will grow to be about $104,000 after 20 years at 8%. And that's the real spread cost that someone buying an annuity, if they live the 20 years and then die, to use the same assumption period, is suffering by buying the annuity. The blissfully ignorant annuity payout recipient will get $660 a month. If he, and men have shorter life expectancies, dies sooner than 20 years, the insurance company pockets the unpaid balance. If she outlives the 20 years, the company will have to keep paying out of its profit until she dies. To put things in a modern context, the payment would be $417 a month over 20 years with a 0 interest rate. But those that say the annuity owner bets they'll outlive their life expectancy and the insurance company bets that they will die sooner really miss the point. Insurance companies endeavor to predict with cold accuracy how long the average annuitant will live and build in a healthy margin to make sure they make money. And the trick is really in the interest rate used to figure the annuity payments. The lower it is, the lower the payment, and the more profitable the product for the company. Back in the 1990s, as a life agent selling these kinds of products, I was constantly amazed at the difference in offered payouts for the same person for the same premium. Given, we presume, the same assumed life expectancy and the same premium dollars offered, the monthly payout quotes varied widely. The only difference was in the interest rate used to figure the payout, and the profit for the insurance company, and the commission paid to the agent. The more profit for the insurance company and the higher commission, it's got to lower the payments. Something's got to give, right? Once you get a feel for this sort of black art, all kinds of payout periods come to mind. Jointed survivor means we'll pay until the last of 2 people die, and of course, given their sexes and ages, we can figure a joint life expectancy on which to base this payout period. Jointed 1/2 survivor, no problem. We'll figure full payout for his life expectancy, then makes a payment cut in half for the balance of her life expectancy after he dies. Again, remember, men live typically shorter. Refund annuity, where they'll pay out the unpaid balance of the unpaid initial premium in case he dies before getting all of his initial outlay back at his death. Piece of cake. Since the insurance company can easily compute the average payout term in any such scenario, making money is pretty easy, since it can always figure a payout level less than what it will make on the money paid in via the immediate annuity premium, provided it gets average life expectancy assumptions right. Of course, it does go without saying that the layperson is pretty helpless at trying to duplicate the math and evaluating just what a fair payout level might be. A lot of professionals, professional advisors, and I use that term pretty broadly, but a lot of even very well-studied advisors have a hard time doing the math. It's very, very complicated. Too many folks think that getting the money back, breaking even, after so many years is a fair proposition. But I would differ. Remember that getting $5,000 a year for 20 years is breaking even, but even at 6%, the really fair annual payment is over $8,700, a 74% difference. And as before we think about taxes and inflation, folks, and yes, annuity payments are taxable if you get interest. But still, inflation never sleeps and will erode the value of the payment. So even if you break even, you've lost money. And that most of us can and should shoot for far higher than 6% over a 20-year income period should be pretty clear, even with the low interest rates of the early 21st century. 8% bumps the annual payment to $10,200, more than twice break even. 10% brings it to almost $12,000 annually. But for those with the right training and the right computers, making money by pricing annuities for insurance companies is as easy as setting up the slot machines in a casino. This payment amount, by the way, can be based on the interest rate prevailing at the time of annuitization. Best to shop these, by the way. The rates vary very widely from company to company, even on the same day. In which case we have a fixed immediate annuity whose regular payment amount does not change from the initial schedule. While the schedule can incorporate future changes triggered by events like inflation or the death of an annuitant, the payment itself is determined by the interest rate at annuitization. Variable immediate annuities, on the other hand, have payments whose amounts vary based on the performance of securities markets like stock indices. These can be very complicated beyond the belief of the layperson, and turn out to be real shockers for those on fixed incomes when the markets drop. And I think that's probably enough. That's probably far too much, and I'm sorry for the complexity. But at the end of the day, it's important to appreciate at the core, if you have the necessary knowledge underpinnings, annuities really are pretty simple vehicles. But in actual practice, and especially from a consumer's point, they are just bewilderingly complicated and very hard to shop fairly. Even if you read all the disclosure and its voluminous, it's almost impossible to know if you're getting a fair shake or not. Anyway, I hope that was helpful. Be very careful if you're shopping annuities, and remember, once they annuitize or immediate annuities, they become irrevocable. You can't change your money, get your money back in many cases, so be careful. Tread carefully. Thank you very much. Until next time, I'm Jeff Camarda.